Hello everyone, this is Laurent with HedgeTech. In this video we're going to dive deeper into the strategies, which is the most important part of the software as a service. So in this specific video we're going to look at liquidity providing and spread narrowing strategies. So on the left side here I have the app open with three mock scripts, and I also have the HT client documentation open. So the general objective of all these strategies is the same. It's to provide liquidity, to narrow the spread, but there are some key differences that I would like to point out. So let's go ahead and look at Maker first. I'll scroll down to the Maker section. Okay, so Maker is the traditional market making strategy. It's market neutral, and it aims at price discovery, meaning that the price is going to react according to supply and demand. There's also an objective to preserve inventory, meaning that when the price goes up and down, or down and up, or in other terms it fluctuates within a given range, you're going to make profits from the spread. However, I want to point out to the fact that this is not a profit-oriented strategy, but rather, as I said in the beginning, it's a strategy that is going to provide liquidity and narrow the spread. So let's go over the parameters. Script class is Maker. It's offline because it's a mock strategy, or a mock script rather. So let's look at base. For example, Bitcoin, quote, USDT. So for example, if you have a market like this, the base is the currency that comes first, and the quote is the currency that comes second. Levels is how many orders that you want to place on each side of the order book. So here you would see, so this is the sell side, this is the buy side, and each level is like a different price. Average volume is the volume that you want to place on each level on average, and I will come back to this average term in a second. So here you can see that, for example, on this level, the volume is shifting quite fast, but it's 2 here, 2 point something. So randomness. Randomness is, in order to have an order book that looks more natural, you're going to have a certain probability distribution. It's a gamma distribution if you're interested, that is centered around this average volume. This is why we call it average. And so 0 would be absolutely no randomness, 1 would be maximum randomness. So spread is the difference in price between the sell one and the buy one in percent. So the narrower the spread, the better and the less volatile the market will be. Density is the difference in price in percent between two levels. A quick note on spread and density. You want the spread to be at least 3 times the density, and the difference between spread and density to be at least twice the trading fees on the given platform you're trading on. This is to avoid losses and to make sure that you actually profit from the spread. Okay, cut loss base and cut loss quote are 2 optional parameters. So pretty much when you provide inventory for market making and you want to establish some form of a security mechanism, for example, you don't want your base to go lower than, let's say, 2 Bitcoin, since base is Bitcoin here. I mean, this is dependent on what you want to achieve. And same for quote, you can set sort of like a cut loss, although it's not like pure losses, because pretty much when you trade, you're exchanging one currency for the other. So, but we just called it this way. And finally, the Maker strategy only uses 1 account, as you can see here. All right, so if you scroll down, you'll see this inventory button. This will allow you to check the recommended inventory to provide for the market making script based on the config parameters that you inputted here. And obviously you can do so before the script is turned online. So let's try and see what it gives. So here you see that the recommended inventory is 7.6 Bitcoin and around 100K USDT, which is quite significant. So you might wonder why the recommended inventory is that high, given that we're only placing 40 orders on each side and they're roughly, they're around 200 USDT. And the reason is that we want to cover a wide price range. So we don't want the script to simply stop if the price fluctuates just a little bit. So if a couple orders get filled and replaced, we don't want one side to run completely out of balance. Let's try to see what is the impact of modifying parameters on the recommended inventory. So I'll just change this to like 50 USDT. I'll put a spread that is slightly higher. And the density of, let's say, 0.3. And I'll check the inventory. And you see here that the recommended inventory is actually much smaller. There's one last specificity that I need to point out regarding the maker script. So if you have this script that is running, if it's online, and you need to modify these parameters listed here on the documentation, what you need to do is that you first need to turn the script offline. You need to clear storage here, clear orders, modify the parameters, and then restart the script. This is not the case for other script classes. Okay, so let's move on to stable. So here is a stable example. Let me go to the corresponding section in the documentation. So stable is a script class that is suitable for stable coins, obviously, or if you want to match the price on your platform to a price reporting platform like CoinGecko. So let's say you're running an exchange and you have a Bitcoin pair, for example, against USDT. What you can do is that you can match the price on your platform to the price on the price reporting platform. For stable, there is one tricky point that you should be careful about. So let's say that you have an exchange and you have a Bitcoin against USDT pair. And let's say that the price on your platform is 8.7K for Bitcoin against USDT. And the price on CoinGecko is 9K. And let's say that you have large sell orders on the way up to 9K. What the script is going to do is that it's going to match the price on CoinGecko. So it will attempt to fill sell orders by placing market buy orders. And in doing so, you might end up running out of balance on one side. So you should be careful regarding this point if you attempt to match the price on CoinGecko, for example. Okay, so let's look at the unique parameters for this script class. So base, quote are the same as for maker. Base value is the USD value of the base currency. So here, for example, on the Bitcoin against USDT market, I'm going to input a market parameter value for base value, meaning that I'm going to match the price on CoinGecko. For quote value, however, since it's USDT, I'm just going to input 1. And then askNum and bidNum, so pretty much you can input different number of levels, which is different than for the maker strategy. And that's about it for stable. For stable, you also don't need to restart the script if you want to modify parameters. All right, so let's move on to the order book replication strategy. And I'll go to the corresponding section. There it is. So order book replication allows you to completely hedge the risk by taking liquidity from a larger exchange. It requires a little less inventory than, for example, the maker strategy, but there are a couple cons to this strategy. The first one is that the spread that can be achieved with the order book replication strategy will be higher than the one that can be achieved with the maker strategy, for example. And I'll come back to that in a minute. Second, you need 2 accounts for this strategy, as you can see here. And this is because you will have one account on a smaller exchange where you want to provide liquidity, and one account on a larger exchange where you want to take liquidity from. And lastly, you will have to do rebalance between these accounts. So let's say that you will have an extra quote currency, for example, on one of these accounts, and extra base currency on the other account. So once again, let's look at the parameters that are unique to the strategy. Base and quote is the same, divergence is different. So divergence is the distance between the orders you place on the smaller exchange and the orders on the larger exchange that are already standing. If you want to preserve inventory, it is recommended that you put a divergence that is enough to cover the trading fees on both exchanges, as well as the transaction fee from one exchange to the other. And finally, the divergence has to be at least 2 base price units. One thing to note is that if you put a divergence that is large enough, you can actually make money from the order book replication strategy. Levels is the same as for maker and stable. Percentage is the percentage of liquidity that you want to replicate from the larger exchange to the smaller exchange. And it shouldn't be above 20%. Volume cap allows you to put a hard maximum on the amount that you're going to place on each level. So for example, you can set, here I set a volume cap of 400 USDT. This is at your own discretion. Randomness is slightly different compared to the maker and stable strategies. What it's going to do is that when you replicate in a certain percentage of the amount on each level, let's say 20% of an order on the larger exchange, and this exceeds the volume cap that you set here, randomness is just going to allow you to put an amount on that level that is around the volume cap, but that is not exactly the volume cap. And this is, again, to make the order book look a little more natural. And then finally, you have cut loss base and cut loss quote, and these are exactly the same. All right, so that's about it for the liquidity providing and spread narrowing strategies. If you have any doubts or any questions, feel free to reach out to us and we'll be able to guide you through the process. In the next video, we will talk about enter and exit strategies. Thanks for watching.